Hello and good evening, everyone. We should be starting shortly, waiting for some people to be admitted. So maybe another 2 to 3 minutes and then we are on. Maybe we can slowly start and let people continue to join as they are still people in the waiting room. But good evening, all of you. And as all of you are aware, the purpose of today's meeting is to discuss the issues that arise out of the 15th February circular of the RBI, which is sort of a clarification on the 12th November circular, which itself was a clarification. And as quite often happens, a clarification leads to a confusion, and then there is a need to clarify the clarification itself. Needless to say, the 12th November circular of the RBI was responsible for major concern across the NBFC sector. And indeed, by now, I think everyone is familiar with what it entailed, and everyone must have gone through the process of implementing the 12th November circular already. The 12th November circular, among other things, talked about a day-wise or day-end recognition of NPAs. That is something which is more like a system issue. But most importantly, it led to saying that if a borrower had hit 90 days in the past, and even if the current DPD status comes to less than 90 days, the borrower would still remain an NPA until the borrower clears all his dues. I think the common point that we've been hearing across ever since the 12th November circular, and I think everyone would share that perception, that if a borrower has indeed defaulted for 3 months, it wasn't something that he would have wanted to be defaulting. It's not something which is a case of his so-called willingness. He's not a so-called willful defaulter. And somebody who has sort of accumulated 3 months of dues, for him to be able to gather resources to bring down his DPD status to zero is mostly impractical. That doesn't typically happen. It takes time for the borrower to garner resources to be able to clean up his dues. And therefore, once an NPA remains an NPA was possibly the outcome of the 12th November circular. This is the way banks have been treating their borrowers in the past, but for NBFCs, this was a major change. And as I'm sure all of you are aware, because most of you would have prepared Q3 financial results already, the GNPA ratios of most of the major NBFCs have surged tremendously as a result of the 12th November reclassification. Uh, we have collected some of the snippets from various press reports. I don't intend to sort of use corporate names here. I don't even want many of them maybe participating today in some way, but we just gathered some of the press reports. So the data on the left hand, which are naming some companies, the intent is not to name companies, but the intent is simply to show that GNP ratios of many of the companies have actually gone up by significant percentage points. Even some of the most reputed housing finance companies, they've also seen a surge in their, I mean, it's not an ordinary surge, it's an increase which is anyway more than ordinary. And the rating agencies have also been consistently commenting that the GNP and NNPA ratios of NBFCs would increase pursuant to the 12th November circular. In light of this, well, the 15th February clarification, so-called clarification, in any case, of course, it was quite a soothing relief, because most of the NBFCs were actually facing the tremendous pressure of the 12th November circulars. It was sounding like a relief. But there were, of course, several questions, and several people have actually been sort of stating that it's actually not a relief towards implementation of the 12th November circular, but indeed it's only a relief for system upgradation. As far as implementation is concerned, the implementation still needs to be done, because 12th November circular did not have any timeline as such. It was due for immediate implementation. And therefore, some people are actually saying that it's not a sort of deferred implementation of para 10 of the circular. That still remains immediate. But the RBI possibly gave some time to NBFCs to upgrade their systems. So it's only a system relief and not an implementation relief. That's the view that some people seem to have taken. Now, we thought it might be opportune to gather industry experts because this is a very, very important notification, to see what are views of other industry participants on this very sensitive issue. So that's the purpose of today's meeting. It's intended to be completely participative. So in case any of you have any comments, any of you have any thoughts, please feel free to share. And my colleagues will be happy to unmute you. I guess you can unmute yourself as well. But if need be, please make a request and my colleagues will be happy to unmute you. So we just start with a quick background and some of the important ingredients of the 15th February clarification. And then we come to this very significant issue. If at all somebody wants to avail of this, let's say, deferral, what does it actually imply? What are the various complexities around making this change at just this juncture, where we are already on 15th of post 15th of February, and you already might have completed your Q3 financial results and would have probably gone public. So first of all, the basis of the entire exercise is the income recognition and asset classification and provisioning norms, which were 1st October 2021. And then the same norms were extended to NBFCs too. And then there was a clarification, the 12th November circular of the RBI, which was styled as a clarification. The fact that the RBI says it's a clarification actually means it's not a change of position, it's not an amendment of the IRACP norms, IRACP norms. It's merely a clarification to the norms. If it's a clarification means it always was the intent of the regulator, and therefore it anyways applicable with immediate effect. For some of the paragraphs of the 12th November circular, there were timelines for implementation, but the important paragraph which led to the new norm for NPA treatment, meaning based on past history of dues or past history of DPD, and not the current status. That was paragraph 10. Paragraph 10 did not have any specific timeline for implementation, which means it was applicable immediately. Now, we did a webinar on the 12th November cycle, I believe on the 18th or 19th, probably on 19th of November. And we had over 300 participants. Of course, it was a major concern. So I think it was the number of participants by itself indicates the extent of concern across the financial sector. So we had a tremendous interest in that particular webinar. And as would be expected, there were a lot of industry representations as well. There was an industry representation by Finance Industry Development Council. Upon receiving that representation, that was dated 18th of November itself, and subsequent thereto, on the 13th of December 2021, the RBI wrote back by way of a letter expressing its inability to accede to the request. What was the request? The request was relief to NBFCs by way of deferring the date. In a sense, by 13 December 2021, the RBI made its mind clear that whatever date, that is immediate implementation of the 12th November circular, there was no question of going back on that. And therefore, the request for extending time was flatly denied. This is as on 13 December. So obviously thereafter, the third quarter would have ended and people would have actually implemented the 12th November cycle. Implementation would mean what? Number one, that you implement new norms for NPA recognition. That is based on whatever whichever borrowers might have turned into more than 90 days on or after 12th November 2021, even if the DPD status as on 31st December or any date during the quarter was less than 90, the borrower would still be regarded as a non-performing asset, and which is the reason for the surge in NPA numbers I was referring to. On the 15th February, which means a good 45 days after the end of the third quarter. By the way, as is a common knowledge, most of the larger NBFCs are equity listed NBFCs. Some of them are debt listed entities, and debt listed entities also by virtue of listing obligations and disclosure requirement regulations, they are also now required to prepare quarterly financial statements. So I would say all leading NBFCs, barring the small ones, which do not either have equity shares listed, nor do they have their debt security listed. By and large, I would say in terms of value, 95 to 98% of the entire financial sector would have already implemented the 12th November circular by way of third quarter results. Some companies, I'm told, have not gone and they have probably declared the GNPA numbers in terms of investor reports, investor presentations, but they've not made any explicit impact of the 12th November circular in their Q3 results as such. So there are some people who I'm told have not gone ahead and done any impact on the results at all, but they've simply made some point of GNPA computation by way of the investor presentations. But the question is that for many NBFCs which have gone ahead and given impact of the 12th November as a part of the financial statements, what does this 15th February so-called clarification actually mean? Like we said, GNPA ratios and NPA ratios of most of the NBFCs have gone up. Now, before we get into this question of how does one interpret, and if at all one takes the view that it's actually a deferral of the implementation, how do we actually take advantage of the deferral? Do you take advantage? Strategic question. How do you take advantage? Practical question. What do you do for what you've already done? That is, for Q3, you've already gone and done something. Can you backtrack on that? So there are several questions that come up on this 15th February so-called clarificatory note of the RBI. So before we get into that, let's first quickly see what all does the 15th February circular actually entail. So basically it entails four major things. One, of course, is on the so-called out of order status. Now, the so-called out of order status pertains to the paragraph in the 12th November circular, which dealt with overdrafts and cash credit facilities. And it says in case of cash credits and overdraft facilities, even if there is no interest required to be serviced during the quarter, but for 90 days, there is no actual credit received from the borrower, or the actual credits are less than the interest due on the working capital or cash credit facility, then also the overdraft or CC facility will be regarded as being out of order. So this was actually defining in case of overdrafts and cash credits, what is the meaning of out of order? In what circumstances do we regard an overdraft or cash credit facility is out of order? Now, we are aware that this particular clause of the 12th November circular is being read by some people as leading to an interpretation that if you have a loan which is actually not in the form of overdraft, if your loan, and in that loan there is no the loan provides that there will be no interest payment. The loan is one which does not require interest payment. Let's say it's a bullet repaying loan. Say for instance you have 1 year loan and the entire loan along with interest is payable at the end of 1 year. Therefore, there's no question of any payment over 90 days period. And therefore, some people are saying that now the stipulation of the RBI is that every facility must actually have a monthly servicing of interest. And if the facility itself provides for no servicing of interest, and therefore no credit is received from the borrower over the 90 days or 12 months period, then the facility would still be regarded as a non-performing asset. This is one possible interpretation. Now, I don't think the 15th February circular actually clarifies the position. What it says definition of out of order includes all loan products being offered as an overdraft facility. Being offered as an overdraft facility, including those not meant for business purposes and or which entail interest repayments as the only credits. And in that case, the circular goes to say that if no credits are received within 90 days, no credits are received, or the credits are less than the interest payment, then the facility would still be regarded as a non-performing asset. So there are, I mean, in the NBFC sector, we are aware that there are products where people offer almost like a revolving credit facility. If a revolving credit facility or equivalent thereof is being offered, where the borrower may repay the facility and then the sanction limit becomes once again eligible to be drawn against. For example, let's say we offer 1 lakh rupee as a credit as the kind of line of credit, and I draw 50,000 out of that. I of course have the right to withdraw another 50,000. Now I've drawn 50,000 and let's say I pay 40,000 back. That would mean my outstanding amount is now 10,000, and therefore the remaining 90,000 once again becomes alive for withdrawal. If that's the case, does it amount to offering a revolving line of credit? So what exactly is and in that case, will this revolving line of credit be regarded as a sort of an overdraft? Technically, the word overdraft means when the account is drawn beyond the balance therein. That's the definition of overdraft anyway. As you can see, definitions of overdraft and cash credit both cited on screen. They're coming from the RBI's guidance itself. Both cash credit and overdraft actually relate to an account which gets drawn beyond what is actually the current balance, which I think all of us understand that if I've got, let's say, 50,000 rupees in my account and the banker allows me to draw 80,000 rupees, the excess, that is 30,000, becomes an overdraft. So overdraft, but is this paragraph relevant for overdrafts only, or can this paragraph be made applicable to any loan facility which does not provide for interest payment on monthly basis, and therefore if no interest is collected for 3 months or the amount collected is less than 3 months anyway, can such a facility be regarded as having become an NPA? Now this question does not have an easy answer for sure. I'm not therefore advocating or sort of stating that every loan with a bullet repayment amounts to an overdraft. Overdraft technically, as is defined there, means a facility where the customer is allowed to draw an agreed sum in excess of the credit balance. A loan is certainly not an overdraft, and it seems, at least based on our reading, that this particular paragraph of the 12th November circular still pertains to overdrafts only. And for NBFCs, since overdrafts are not, or revolving lines of credit are not quite common, there might even be an understanding that revolving line of credit cannot be offered by NBFCs. That is not the question that we need to get into today. But Not that every loan which permits interest to be paid by way of a one single bullet repayment at the end of, let's say, 1 year, or end of the maturity, or at the time of maturity of the loan, may be regarded as having become an NPA merely because no interest is served over the 9 month or 3 months period. So this particular paragraph in our reading is still relevant for overdrafts and cannot extend to every single loan where interest is not serviced. The second clarification which comes from the RBI circular is that as far as reporting to CRILC is concerned, there is no change in that requirement. That would mean that requirement, reporting to CRILC, will continue to be governed in terms of the existing instructions for respective entities. As of now, as you are all aware, CRILC reporting is applicable where the aggregate fund-based limit of a borrower, fund-based and non-fund-based exposure, is 5 crores and above. In that case, we report the SMA status and the NPA status of the borrower to CRILC. So that reporting will continue, and therefore there's no impact of that and the impact of the 12th November circular on CRILC reporting. Question arises, will the 12th November circular impact the CIC, credit information company reporting too? Because in case of credit information companies too, as we now understand, the reporting format has changed, and now you're required to report not just the days past due, but even the SMA and the NPA status of the borrower. Will the reporting to credit information companies be based on the regulatory classification? That would mean if the borrower is currently at 60 days, but in the past it was, let's say, at excess of 90 days, and therefore as per regulatory classification, the borrower is an NPA. Does that mean even for the purpose of CIBIL or CIC reporting, the borrower still is an NPA? I think the answer should appropriately be yes, because if you are reporting SMA status, NPA status, then SMA or NPA status is actually actually an outcome of regulatory classification. And if regulatory classification treats the borrower as an NPA based on past history of delays, not necessarily the current DPD status, then that status should be aligned with the CIC reporting as well. So in our view, the CRILC reporting will remain unaffected. CIC reporting should be aligned with the regulatory classification. Now, another point which the 15th February circular seeks to clarify, and in our mind, we never had a doubt on that because we had consistently opined that accounting provisions, if the companies adopted Ind AS 109, accounting provisions will be driven by accounting standards and are not impacted by the RBI's change of regulatory classification, because stage 1, stage 2, stage 3, as per the accounting standards, are based on the definition of default given in the accounting standards. Stage 3, for example, is based on definition of default, and default is deemed to have occurred when the borrower is more than 90 days. I mean, it's a rebuttable presumption, of course, when the borrower is more than 90 days past due. That stage 3 classification for Ind AS purposes, or for that matter, stage 1 or stage 2, are independent of the regulatory classification. There wasn't any change in Ind AS requirements. RBI's regulatory classification does not impact Ind AS staging, and therefore our view consistently was that Ind AS classification will remain unimpacted. So the 12th November circular did not lead to any change in provisioning requirements as per ECL provisions, expected credit loss provision. Of course, the provisioning requirement as per NPAs might be impacted, but for most of the NBFCs, the ECL provision was anyway higher than the regulatory provision. So there wouldn't have been an impact on the reported P&L still. However, if some people have actually gone and, let's say, changed the staging as well, if people have, let's say, reflected the regulatory change of classification in their Ind AS staging too, in that case, the provisions might get impacted. Or, by the way, if the regulatory provisions based on NPA classification are in excess of ECL provision, the company would still debit ECL in the books of accounts and would credit the difference between regulatory provision and the ECL as what is called impairment reserve. But therefore, there might be a possibility of impact on P&L account, but for most of the companies, the P&L impact would either not be there at all, or might have been there, one doesn't know. But the RBI now clarifies, and like I said, for us it was always clear, but good that the regulator has also put it in absolutely clear terms, that the 12th November circular does not impact India's classification. So India's classification will still be driven by the relevant accounting standard, which is India's 109, and therefore you can still rely on definition of default given in India's and not be driven by the RBI's change of or the recognition as per RBI. Now, another very important clarification on this also, our view was clear in the past as well. I think our FAQs also made it very clear that if there are more than one facility with a single borrower, there are two loans, for example, with a particular borrower, and one loan has turned an NPA because of, let's say, past dues of more than 90 days, one loan has turned NPA. The other loan is, let's say, trailing at 50 or 60 days. Then there was a question when the regulation says that the loan should be brought to zero by the borrower. Does it mean all the loans should be brought to zero or only the loan which had exceeded 90 days in the past? To take an example, you can see examples on the right hand side. If the borrower has, let's say, two loans, let's say loan X and loan Y, you're given two facilities to a same borrower, let's say loan X and loan Y. And let's say loan X touched 110 days in the past, and therefore it was taken to be an NPA. But now it's trailing at, let's say, 60 days. So as per 12th November circular, even though the loan is trailing at 60, which is less than 90, but in view of the past history of non-performance, the loan would still be taken as NPA, loan X. The other loan, which is, let's say, loan Y, the maximum delay in the past was only, let's say, 30 to 60 days. Say in the second loan, loan Y, the delay in the past was 30 to 60 days. Now, in order to upgrade the borrower, because the principle is that if there are two loans to a borrower, what becomes NPA is the borrower, not the loan. That's, I think, settled principle that what is NPA is the loan and not, sorry, what is NPA is the borrower and not the loan. So if there are two loans to a single borrower and one of the loans has turned an NPA, despite the other loan, say, being at 0 DPD, the other loan will also be treated as an NPA. So multiple facilities to a single borrower, one facility goes NPA, all the facilities to the same borrower or the same beneficiary. The regulation uses the term same borrower, same beneficiary. The word beneficiary relates to beneficiary of a guarantee. Then all facilities to the same borrower or same beneficiary will also be treated as having turned NPA. Now, in this example, supposing loan X was the root cause of the entire, the group of loans to the borrower having turned NPA, because loan X was at more than 90 days in the past. Loan Y never was. Now, if the borrower clears all his dues for loan X, in order to upgrade him to standard status, because loan Y was never responsible for maligning the status. So even if, let's say, loan Y was trailing at 30, 60 days, does loan Y also have to be cleared and brought to zero status? That would mean, do we expect the borrower to put both the facilities to 0 DPD in order to upgrade the borrower to a standard account, standard borrower? On this, there was a confusion earlier, or potential confusion earlier. The RBI clarifies that the intent is that all the facilities to the borrower, that would mean both loan X and loan Y, should be fully cleared. The due should be fully cleared before treating the borrower as having become standard. Therefore, both the loan X and loan Y have to be brought to 0 DPD in order to upgrade the borrower. Just twist the example a bit. Supposing loan X was in the past 110 days. On 31st December, let's say it was 60 days. Loan Y on 31st December was 0 DPD. Loan Y was 0 DPD on 31st. In other words, loan Y did not have a DPD at all. Now, on 31st December, or let's say on 1st of January, the borrower clears the entire overdues of loan X. Loan Y was already 0 DPD. So does that mean the borrower can now be upgraded to a standard account? The answer is very surely yes. The intent is that if there are multiple accounts to a borrower, the borrower should clean up his overdues for both the facilities in order to be upgraded to a standard account. That's first example. Second example, slight variation. Suppose we have two loans, loan X and loan Y. For loan X, the borrower is single sole borrower. For loan Y, the borrower is a co-borrower. I'm sure you would all agree that in the past, many people have gone and moved from a concept of guarantee to a concept of co-applicant to co-borrower for whatever reason. I thought that this practice started because of, I mean, in case of corporate borrowers, because of Companies Act issues. But I see that's the quite widely prevalent practice with many NBFCs is that they give a loan and they have someone to guarantee the loan, but instead of making him as a guarantor, they make him a co-borrower. Co-borrower means what? Co-borrower by definition means joint obligation. There is a question coming on screen, and Sonal, in case you want, you can speak up too, but I'm exactly discussing the point that you probably have asked. But maybe after a minute from here, if you still have a question, you can please feel free to speak. In this particular group today, we have the privilege of having, I mean, all of you, and I think we don't have a sort of an unwieldy number. So in case any of you want to just speak up and raise your question vocally, you can actually do that. Please feel free to just ask my colleagues to unmute you and we'll be happy to do it. But let me just quickly talk about this. So I said, while the intent was to actually have the other person as a guarantor, but for whatever reasons, right reasons or wrong reasons, instead of having the guarantor as a guarantor, we introduced the guarantor as a co-borrower. Now, this so-called co-borrower for this loan is also, let's say, sole borrower for some other loan. So loan X has a sole borrower and loan Y has two borrowers, both of whom are co-borrowers. One of the co-borrowers has become an NPA. One of the co-borrowers has become an NPA because of, let's say, his sole loan having turned more than 90 days past due. Does that mean the other loan, because of the co-borrowing position, the co-borrowed loan, which is actually not loan to one person but to two persons together, will that also be treated as NPA? You may not like what I'm going to say, but I will still have to say that if there are A and B, there's a loan given to A, there's a loan given to B, and there's a loan given to A and B both. And say the loan given to B turns an NPA, then the loan which is given to A and B should also be an NPA. Why? The argument is that if there were two borrowers, they had a joint and several responsibility. What was obligation of joint and the responsibility of a guarantor and that of a joint borrower is different. Joint borrower is sort of originally liable by way of a joint and several obligation. Joint and several obligation. Either of the borrowers should be paying the loan. So if B's loan has turned NPA, then the joint loan to A and B also becomes NPA. And if the joint loan to A and B becomes an NPA, it's a possible argument to say that the loan given to A, sole loan given to A also turns an NPA. So it's sort of because of default of one, the joint loan became an NPA, and because of that, the other solo loan might also turn NPA. This is a potential downside of co-borrowing situation. Co-borrowing is something which was possibly a way out in case of corporate loans to avoid Section 185 or let's say loans to directors. But if it deployed sort of randomly, it may have undesirable consequences. The third example, if let's say I have a loan X to a borrower and a loan Y where he's not a borrower but a guarantor. In case of loan X, he's a borrower himself. In case of a loan Y, he's simply guarantor. He's not a borrower. And let's say the other loan where he's a guarantor, loan Y where he's a guarantor, that loan because of the borrower's default turns non-performing. Does that mean loan X where I'm the principal debtor, that also becomes non-performing? In my view, not. Because guarantor, like we said sometime back, facilities given to the borrower or to the beneficiary. In case of loan Y, the borrower simply a guarantor, is not a beneficiary. Beneficiary was someone else. So had he been the beneficiary, then the loan would have turned NPA. By merely being a guarantor and the principal debtor's loan turning a non-performing asset, that the guarantee by itself does not turn, unless of course if the guarantee is invoked and the payment obligation therefore shifts to the guarantor, and then let's say the guarantor still does not pay, then the guarantor might also become an NPA. So that's the position about guarantees and the position about joint loans or co-borrowing transactions might be a little different. Now comes the most critical part of the 15th February circular, which is the last paragraph of the circular. And I'm reading from the circular. It says NBFCs shall have time till September 30, 2022 to put in place the necessary systems to implement upgradation provision. The upgradation provision is the one that comes from paragraph 10. And then it goes to say all other instructions of November circular shall continue to be applicable as per the timeline specified therein. So does this last para have the effect of deferring or permitting a deferred implementation of paragraph 10 till September 30, 2022? So basically, we have 3 more quarters, Q4 of 22 and then Q1 and Q2 of 23 for implementing paragraph 10. Rest of the paragraphs of the 12th November circular are still applicable. There's no doubt on that. But as regards para 10, is the RBI intending to grant further time of 3 quarters for implementation, or is it simply a relief to sort of upgrade systems? Some people have read that the language says NBFC shall have a time to upgrade systems, NBFC time for system implementation. So is it only system-driven implementation that is being deferred, or the implementation of paragraph 10 itself is deferred? That question, now, like I said, every clarification has a potential for confusion as well. So the confusion in the clarification is that a lot of people do not find it clear whether the RBI was actually intending to relax the implementation, and that too on 15th of February, or it simply gave a time for sort of modifying and putting in place systems. So it's only a relief for systems and not a relief for implementation itself. So there are 2 possible interpretations, and our objective is to sort of see if we can have some consensus. So normally having a consensus is not, all that easy, but let's possibly try to see if there's a possibility of driving some consensus, or to say where does the weight of argument lie. Where does the weight of argument lie, so that if there are 2 possible interpretations, we can probably select the one where we have more weight in terms of the possible intent of the RBI. So first possible question could be that if at all the RBI wanted to defer the implementation in response to the FIDC's letter, I think December sometime, 13 December or something, the RBI said nothing doing, we are going ahead with paragraph 10. Therefore, your request for deferral is turned down. The RBI turned it down. And then, well, Q3 ended on 31st December. People came with published financial statements. As is quite evident, a lot of NBFCs showed a sharp increase in GNPA ratios. And come 15th February, the RBI comes with a circle. So if the idea was to defer, would they not have done it before the end of 3rd quarter? 3rd quarter having ended, and NBFCs already having implemented that, most of the leading NBFCs anyways, what could be the prudence in coming on 15th February and thinking of a 2-3 quarter deferral? So the counter argument to this would be that, well, the results for the 3rd quarter for most of the NBFCs were sounding disturbing, even if I don't call them kind of precarious, but they were sounding, the situation was definitely not very comfortable. And if this situation continued for the 4th quarter, sure enough, the year-end results for most of the NBFCs would have been impacted. Even if the financial results not, but the GNPA itself would have been scary. And I'm sure you all appreciate that GNPA itself is not simply a number. The GNPA also has multiple impact. For instance, if NNPA ratios goes above 6%, your dividend distribution will have to be stopped. For also, I do understand that most of the banks, while giving sanction for facilities to NBFCs, they also put a condition relating to GNPA. If GNPA ratios exceeds a particular number, the bank will stop lending further. So GNPA is not merely a number in the investor presentations. It's not merely a statistical matter. It has real business significance as well. So if the Q4 or the year ending of 2022 showed a dismal performance of NBFCs in terms of GNPAs, would that not impact India's growth story? Would that not impact the 8.5% GDP that we are ambitiously talking about? Would that not impact the liquidity in the hands of people? Would that not impact the idea of financial inclusion? So the entire growth story that the country is currently, trying to live through or trying to sort of realize, NBFCs are a crucial player. Gone are the days when the government viewed NBFCs as sort of competitors with banks. Today, the government is fully aware that NBFCs are the carriers or the agents of financial inclusion. So if liquidity in the hands of customers, borrowers, is a significant issue in financial growth, NBFCs are clearly the agents for that, and therefore the government doesn't want to do anything or cannot afford to do anything which could disrupt the NBFC sector. So maybe after seeing the Q3 results of leading NBFCs, the RBI would have thought that if this situation is allowed to continue, it might cause a disruption, and therefore it is important to grant a deferral. Why deferral for 3 quarters? Possibly thinking that within 2 to 3 quarters, the impact of COVID would subside, and therefore things would turn more or less to normal when it comes to borrower behavior, and therefore the NPAs themselves could probably decline. So COVID impact might have been a region, and well, I think strongly by influenced by after seeing the Q3 numbers, the idea might have sort of gained strength that there is a need to grant a deferral. So therefore, the intent might actually be to grant a deferral. Now, both arguments, let's weigh the two. First argument, that it's only a relief for system upgradation. The exact language says, NBFCs shall have time till September 30th to put in place the necessary systems to implement this provision. And therefore, one can argue that the RBI simply gave a time for system-based implementation. By the way, when it comes to NPA computation, it is expected to be based on systems. This is coming from the so-called IT framework, which says identification and classification of SMA and NPA accounts shall be based on systems. It shouldn't be a manual computation, it should be a system-driven computation. So this so-called relief was not a relief for implementation of paragraph 10, but was a relief merely for putting in place IT systems, which is coming from the IT framework. That is to say, if NBFCs do not implement paragraph 10 at all, the RBI would still take adverse observation on that. But NBFCs do it without relying on systems, without putting in place systems, the regulator would still be okay with that. That is one possible interpretation, that it's only a sort of breathing space for systems to be put in place, but there's no relief for implementation as such. That's one possible argument. Second possible argument is that effectively the intent of the RBI is very clearly deferring the implementation of the paragraph 10 of 12th number circle. Why? Paragraph 10 by itself never referred to systems. Paragraph 10, the original language, did not talk about systems. If there was no mention of the systems in paragraph 10, then the fact that the regulatory recognition that systems will need to be put in place, systems will be required to be put in place in order to align with the new computation methodology, it's itself a recognition that there is a difficulty in implementing it, and therefore the RBI is actually wanting to give further time. Now, why therefore a reference to systems? The possible contention could be that having once turned down the request as made by FIDC, if the RBI is now going back on its earlier statement, it probably realizes that, well, there is a system issue and maybe it's based on a representation by a lot of NBFCs, particularly those NBFCs which have a lot of retail accounts. And therefore, in absence of systems, there's no way companies can compute the revised position. Think of NBFCs with lakhs of borrowers. Other than through systems, how can NBFCs put in place a computation algo? So if systems are not in place, or systems may take time to be put in place, that would mean implementation itself is difficult, and hence the need to defer them or sort of have a phased or deferred implementation. The next reason for saying this or holding this view is that the concluding line of that very paragraph is that all other instructions of the circular, I'm reading from the 12th, the 15th February circular itself, all other instructions meaning other than those relating to paragraph 10, shall continue to be applicable as per the timeline specified therein. So you can see what does this actually mean. That rest of the timelines will remain unaffected, but as regards the timeline for the 10th paragraph 10, I am granting you time. And third, paragraph 10 is not about systems. Paragraph 10 is new approach to upgradation, which of course has to come from system. Therefore, if you late on systems, if you relate it to systems, then the RBI is effectively wanting to give time. So I think the view therefore is that the intent is actually to defer the implementation of paragraph 10. It's not merely system relief. However, I do realize that people have different views on that. So maybe you can take your own view though. But our view is that it's a reprieve. It's a sort of deferral of paragraph 10. The reprieve may have come a day too late, but well, it's I think still a welcome reprieve when it comes to Q4. So how to therefore, if it's a deferral of the implementation, how does one actually take advantage of the deferral? So we can think of various types of NBFCs. NBFCs which have already amended the policy. There are NBFCs which amended their NPA policy itself, and they have implemented the provisions for upgradation of Q3. NBFCs have implemented paragraph 10. They also have correspondingly redefined NPAs as a part of the NPA policy. They've taken a board approved policy amendment and redefined NPAs. That's one category. Second category is some NBFCs have gone further, and they've even created additional provisions in books also. Like I mentioned earlier, either people held the view that change of regulatory classification will be reflected on India's staging as well, or for some people, the regulatory provisions might be in excess of the India's provisions. So for some people, there might have been an impact on the published financial statements too. That's second position. Third situation is that NBFCs have not amended the policy, but they followed the 12th November clarification for the third quarter financial statements. And because of this, a customer who was at less than 90 days as on 31st December would have been taken as an NPA. That would mean the 12th November circular has been implemented. Case 1, 12th November circular implemented along with policy change. Case 2, including a change in accounting provision 2. Case 3, no change in policy, however, a change in NPA treatment. And case 4, there are some NBFCs which have not implemented 12th November at all, or they are not required to publish quarterly statements. I'm told that there are some NBFCs which have simply mentioned the GNPA number as a part of their investor presentations, and that they've not either officially implemented 12th November, nor have, or there are some which are not even required. For example, smaller unlisted NBFCs which are not required to publish quarterly accounts. Now, depending on where you are, how do you actually, take advantage? If at all you think that you would take advantage of the deferral, how do you take advantage? First question, since the paragraph talks about systems, NBFCs shall have a time to put in place necessary systems. If we contend that the systems are already in place, if the systems are already in place, because for Q3, you have gone and done the computation. Computation as per the revised methodology coming out of 12th November circular have already been made in the third quarter. Is it still open for the NBFC to go and late on system and say that I need time because my systems are not in place? That's one question. Now, this question as to why having admittedly system ability, that's exactly why you implemented the 12th November circular. And how do you therefore in Q4, if you want to take the advantage of the circular and you want to go back and revert to the old classification norm, can you say that it's because of system that I'm wanting further time? So in other words, is it a conditional relaxation that is conditional upon systems not being in place, or is it unconditional relaxation? In our reading, there's nothing in the paragraph of 15 February clarification which suggests that it's only for those companies who find difficulty in implementing the 12th November circular because of system issue. It says NBFCs shall have time till September 30, 2022 without, well, of course, it's sort of accounted for because of system issues. It's sort of related with system issues, but the relaxation, if at all we think it's a relaxation, the relaxation is not conditional upon the NBFC proving to anyone that I have a system issue. Now, the issue is that if at all regulator admittedly has granted further time of 3 quarters, can the regulator come back and ask you as to why did you revert or why did you change your computation methodology in Q4 if systems were already in place? Can this question come from the regulator? Can this question come from your auditors? Can the question come from the audit committee or board of directors? Or can the question come from shareholders or other stakeholders? While I do understand internal justification, let's say audit committee getting satisfied, board of directors getting satisfied, that would be an internal call. But to my mind, regulator having admittedly given the relaxation by way of a circular which is applicable to all NBFCs would surely not have an adverse observation if companies have taken advantage of the deferral. So if you want to change the method of NPA recognition on, let's say, or during the fourth quarter, to my mind, it would still be possible to change the methodology and bring it to Q4 status or implement or take in Q4, revise the methodology and relate it to days past due as on the particular date instead of the historical due date. Sorry, I think this matter might require a little further discussion. I'm just coming back to that very quickly. But quickly, what are the other implications if at all you want to roll back and change the methodology to how it was before the 15th or before the 12th November circular? Where all would the rollback impact? First of all, NPA policy. If you have gone and amended the NPA policy, you might need to amend the NPA policy once again. Earlier justification was regulatory change. Now the justification would be regulatory relaxation. Therefore, the NPA policy, if at all policy was amended, pursuant to 12th November circular, the policy would need to be changed once again. That's one. Number two, if you have declared GNPA numbers for Q3, can you go back and revise Q3 numbers once again? Can you go back and amend the third quarter numbers? Now, generally speaking, sort of readjustment of quarterly numbers, quarterly financial results, which are actually called results and not financial statements. Quarterly financial results are not regulated by the accounting standards on interim financial reporting. There's an accounting standard on interim financial reporting, and that does not apply to quarterly financial statement. Quarterly financial results, that's only result. And therefore, it seems possible to readjust or make adjustments in Q3 numbers while preparing the financial statements for Q4. That seems clearly permitted by Regulation 33(3)(I) of LODR regulations. It says that if at all there is a need to readjust the numbers of the third quarter or second quarter or first quarter for that matter, one can do it in the fourth quarter of the financial year. One can do adjustment of the previous quarter's numbers too. So if at all one wants to go back on Q3 numbers, it is possible to do it. However, there will be question of accounting standards. I'm coming to the question of accounting standards also. Now, the next point is that in Q4 of, if you do not want to touch or do not want to sort of go back on the Q3 numbers, in Q4 for sure, you may revert to the old computation method and apply the revised. That would mean going back to where it was before 12th November. You can apply the revised algorithm for treating a loan as an NPA in the fourth quarter. This may also include a borrower who, because of past NPA status, was treated as an NPA on 31st December 2021. On 31st December 2021, the borrower was taken as NPA, not because it was more than 90 days, But because in the past he was more than 90 days, though the DPD status as on 31st December was less than 90. So it's possible to argue that none of what I'm saying is conclusive, because it's too early to sort of draw a conclusion. But if the borrower had already been treated as an NPA on 31st December 2021, declared as such because of the past more than 90 days due, then if in the fourth quarter we change the characterization once again to bring it and relate it to the current DPD status, that would mean based on current DPD, the borrower may be taken as having turned standard. Because if the characterization is based on the current DPD status and not based on past DPD, which means we are not implementing 12th November paragraph 10, and therefore we're not waiting for the borrower to clear all his dues. But because the borrower is less than 90 days, it may be possible to argue that the borrower has now become standard. So that's as far as revisiting the NPA classification. As far as if at all provisions in books of accounts have been made, if for example, let's say either because IRAC provisions are higher than the India's provisions, or say the company reflected the IRAC norms for ECL purposes also, and therefore what was otherwise stage 2 was turned into stage 3. The question is now, can we retrospectively change an accounting estimate? If this is a case of accounting estimate, ECL provision would appropriately be case of accounting estimate. So if ECL has already been provided for in Q3, in Q4, can the company go back and write back what was provided for in Q3? Like I was mentioning, there is a provision in the accounting standards about change of accounting estimates. And that provision says that change of accounting estimates can be given effect only prospectively, not retrospective. Retrospective implementation of change of accounting estimates is possible only in things such as, let's say, useful life, in case of depreciation, etc., which impacts prior computations too. But otherwise, for example, in case of bad debts or any provision which is very similar to ECL, usually a change of estimate will be given effect to prospectively only. But the reference to prospective implementation is for an accounting period. And a quarter, to my mind, is not an accounting period. A quarter is still a part of an accounting period. Accounting period will be the financial year only. So within the financial year, if there was a provision made in Q3 and want to sort of, let's say, revert or revise it in Q4, subject to the regulation I mentioned, regulation 33(3)(I) of LODR regulation, it is still possible. That is, you can do the adjustment in the fourth quarter. Of course, for the purpose of comparison, better to give a note in Q4 that there is a readjustment or recomputation of provisions that we would have done. Regulatory filing, for example, you filed a DNBS for Q3 already. Can you file it again? Now, can this form be refiled? To my mind, perhaps yes, but I don't have a practical exposure on that. So in case you have a different view, you can probably contribute on that. As far as CSC reporting is concerned, if the borrower was treated as an NPA because of his past payment behavior, and let's say because of change of policy now, the borrower is taken to have become standard, will you then therefore start reporting a revised CSC status too? Becomes logical perhaps, because if CIC reporting is coming from regulatory classification, if you want to change regulatory classification, that would reflect on CIC reporting too. So in short, if you want to take advantage of this deferred implementation of the 12th November circular, then in Q4 you may do the adjustment to Q3 numbers as well, if at all Q3 numbers required and change. And this is merely something which needs to be disclosed by way of the Q4 financial results, by way of a comparative disclosure. I think this is what our view would be. Now, we would, of course, want to hear from others. And I think there is a question in the chat too. But before I get into questions, Rajesh ji, are you there? Mr. Rajesh Singhania, is he there? And Rajesh ji, if you can maybe unmute yourself.
Yeah, I'm there, sir. Can you hear me?
Yes, we can hear you.
Yeah. In fact, I must say, it was a very detailed presentation, and it almost covered everything one can think of in terms of the scenarios. And yeah. I hope I am audible. Actually, I am commuting. So
Yes, Rajesh, we understand that you are moving and therefore there might be connection issues. But briefly, would you state your view on whether this paragraph is actually leading to providing deferred implementation or simply a system relief?
see, if it is actually open to interpretation, and like the past circular of 12th November also, I had seen the industry had taken different positions. Some of the NBFCs, they had given impact to P&L by changing the ECL staging, and few had given clear note in their financials. Okay, there is no need to change the Ind AS and ECL staging. So similarly here also, I see there is a clear room for interpretation. If somebody does a narrow reading, it gives its time given for implementation of the systems. But if somebody sees it from a holistic perspective, then give a room. From a regulatory perspective, one can take the benefit of this relief and defer the implementation by 3 quarters. And I also believe we would definitely see mixed practices in the March end accounts, wherein some would take the benefit of this relief and some may not take the benefit of this relief. I would also like to mention that apart from the interpretation issues, it would also be driven by other things like the positions they have taken before the audit committee in terms of NPA policy and the numbers published and results declared or the regulations fine. And also the percentage of NPA, like if somebody's NPA is getting breached by 6%, then it would have impact on even dividend declaration policy and things like that. So people will do their own facts and then take a considered call. And I am sure we will see mixed practices during March end.
Yeah, absolutely right, Rajesh. Thanks for your views. I have a question from Berar. Additional provision of Q3 because of this can be reversed now. Like I mentioned, if you created additional provision books, normally provision shouldn't have been impacted because ECL is not impacted by the accounting standard. But if at all you have created additional provision, you want to go back on the additional provision. In my view, it's still possible because it's a intra-period change. It's not a change across periods. It's not a question of retrospective implementation of a change of accounting estimate because it's still within the period. And in my view is I must say that these views might require further research. I wouldn't like to say that this is a final well-researched view. But from whatever reading we've done of the accounting standard pertaining to accounting estimates, an estimate in Q3 is still liable to change or possible to change in Q4. That would still be treated as a change within the accounting period. Accounting period would still be the year here. I don't know whether Rajesh would want to comment on that.
See, normally, what another thing in terms of provisioning, what I have seen people following is they see what is the closing provision required, less existing provision. So, if somebody takes a position, they would go back to the earlier method and the closing provision required is 100 and the provision as at the end of December is 90, they would make incremental provision of 10 rupees. But this obviously would be subject to alignment with the auditors or their audit committee view. And also it would be a matter of affordability. If people have already taken the bite, they would not like to redo it after 3 quarters because all these differences would remain till September and are not permanent. It's only for the time. So many people may not like to shift considering this. They have already taken the bite, and why to undo now and again redo in September? So it would depend upon case to case, and accordingly people will take the call. That's what I believe.
Absolutely right. I think if people think that the surge in NPA numbers itself is, I mean, transient. It was only because of COVID, therefore it might die down after 2-3 months. Then maybe changing back to the old computation would probably help, because your numbers will look reasonable. And maybe if you think that after 2-3 quarters the NPA numbers themselves will improve, you are actually saving your financials from having the impact of revised methodology. But if you think the numbers anyway would go up in September 2022, then, and if you already have migrated to the new method, maybe you can stay there. So you are, Rajesh, you are right in saying that this is actually a question of strategic choice. Would any other participant want to comment or want to express any view? Or do you want to say whether this is actually a relief in implementation, or do you think it's simply a system relief? Any other thoughts on that? Anyone? Okay, so if not, then it's time for us to thank you all for a very brief notice, very short notice meeting. And with that short notice too, we had a presentation or participation from a lot of people. So thank you very much for participating. It's very important to hear your thoughts. And Rajesh, once again, thanks for being able to present yourself despite your commitments. Thanks once
No,
again.
thanks. It was a good learning, and I had not thought in as much details, and so it was a good learning time for me.
Thanks very much, Rajesh. Thanks, everyone.
Thanks,
Thank you.
thanks, thanks.